welcome everybody. I know quite a lot of you do know Ultimate Products, but for the people that don't know Ultimate Products, I'll just give you a brief understanding. Ultimate Products are the owner of Salter Housewares. Salter Housewares is the UK's oldest houseware brand. It's 260 years old. We also are the owners of Beldray, 1872. And we're very proud to be the custodians of these two major brands. We've been going since 1997, so 25 years. I'm one of the founders with Barry Franks, and we have over 350 employees, most of them in the UK. We have 6 in Europe and 45 in China, in Guangzhou. And we're a brand's house of consumer goods. We're mass market meaning we have the brands and quality brands, but we sell just above own label in the retailers. And we do this to create volume. So the consumer is getting a quality branded product at the right price. We have 5 major categories. We are strong in small domestic appliances, housewares, audio, laundry, and heating and cooling. We've got offices and showrooms in Manchester, which you're welcome to, in Cologne, and also in Guangzhou, and we source from 14 different countries. One of our major strengths is our development systems. We have a capability and do deliver on time 98% to the retailer. Even through the turmoil of the last 2 years, we've been hitting over 96%, which I'm going to talk about a bit later on in this chat. So if we just move on, I just want to give you some highlights of the first half. I know a lot of you have seen this, but the figures are good. They actually could have been better. It is tough. I'm going to be, I'm going to be straight. It's tough out there. The increase in electrics, gas, oil, food, £1,000 or £2,000 net money coming out of 99% of the people in the UK is a lot of money. It's a struggle. So things have toughened. I think what's amplified that is definitely the Ukraine war. People are scared. I'm scared when I turn the news on in the morning. People are worried. So it has gone tough and it will be tough. But in tough times, we do seem to go ahead like we have done in the last 2 years. We've come out of the 2-year COVID and the Brexit, and we are a stronger company, we're a better company, and we've taken market share. And that's what we intend to do over the next year or two with the market the way it is. And I'll go into a bit more about it. Total revenue has increased by 13.7%. Underlying EBITDA increased by 28.7% to 11.3 million. And underlying EBITDA margin increased to 13.1%. Underlying PBT increased 28.6% to 9.9 million. Bank debt is higher, but we've still got big headroom, but I'm going to let Graham talk to you and explain more about that. Underlying earnings per share increased 19.2%, and we've got an interim dividend of 2.3%, which is a 36% increase. And there's not a lot of companies doing that, and we're proud to be able to do that, and hopefully we'll be doing that again at the end of the year when we hit our figures. So the Salter integration, as you all know, we bought the Salter business this year, which is our biggest ever acquisition for £34 million. The integration has gone very, very well. It is significantly earning enhancing, and there is room for growth. We do see with our innovation and our customers that we are going to increase turnover, but not only that, we have not been selling Salter into the European market because we never owned it. It was only a license, and now we own the Salter brand. We are going to be pushing forward and selling this into Europe. We've already sold it to 2 large supermarkets, and they have repeated. So the turnover that we have had off our own products and the scales has been mainly UK, and now which is 70 million people, and now we're going to go for 420 million people with the UK's oldest houseware brand, which is a massive, massive statement. Retailers want to see you when you do make that statement. We've also brought out some new categories, which is high-end laundry and heating and cooling and some wellness products. So very excited about the Salter acquisition, and we own the brand. So now our licenses is only, the turnover on licenses is only 10% of the business. 90% is by the brands that we own. Which takes me nicely on to Petra. We bought the Petra brand just over a year ago for €100,000. Petra is special. Petra, we feel, is like another Beldray. And Beldray, when we bought Beldray many, many years ago, about 10 years ago, was doing zero. Now it does £50 million. And we definitely see Petra as a Beldray. So what we are doing is we're selecting 10 big retailers in Europe, supermarkets, and we're going to promote the Petra brand through these retailers. We're also bringing in 25 lines ourselves, so 25 different products under Petra to put in our new EU warehouse. And these products are going to be promoted online through a Petra shop and through Amazon and other internet retailers to create the brand into Europe. We're very excited about the online play in Europe. Again, I'll go into that just in a few moments. So also the other thing with Petra, we've not been able to do exhibitions for the last 3 years. And exhibitions is a really important part of Ultimate Products growth, because this is where we do pick up customers. You're able to see 400 to 800 customers in a 4 to 5 day period, which is very, very hard to do. The shows are starting again. So we are now exhibiting in IFA, which is in Berlin, which is the largest small domestic appliance and electrical show in the whole of Europe. We used to go there before COVID, but we had a small stand in a back corridor, really, because you can't get into this exhibition. It's so busy. And we have, again, been fortunate because a lot of the Taiwanese, Japanese, Chinese and Hong Kongese people aren't coming to the show. So your Sonys, your JVCs, your Sharps, Samsung. So it's allowed a lot of space to free up. We have managed to get a very large stand in the main hall opposite Ninja and Shark, which are the big A brands. So we're excited for this exhibition. I will talk more about it in November next time we all get together, but it's going to be a big promotion of Petra and also our big release of Salter into the European market. And we'll also have Beldray on there. Salter, there's no investment to take it into Europe because everything's done. All the ranges are done. The only thing we've got to do is change the plugs and some of the test reports. But packaging's done, product's done, and we're excited to launch properly the 2 brands and carry on with Beldray. As you know, as most of you know, we moved into our new offices, which is in the same building, but we moved up a floor, and we are all back to work, which is very, very important because I know a lot of businesses, I'm sure you know a lot of businesses that aren't back to work. And I think this has been key for us. We didn't just ask everyone just to come back on a day. We worked from last March and we communicated it very well, and we consulted with all the committees in our business of how we're going to come back to work and the ideas of coming back to work. And we're all back to work 5 days a week and have been for quite a few months. Not everybody's back to work. What we did is where some people that have caring responsibilities, we have worked with them and we've given those care responsibilities and that time to work at home. If you've got a dentist appointment or a doctor's appointment or your car's breaking down, you know, you don't need to come into work, get that done. But mainly, I will say 95%, we're all back to work. And in business and in a trading business, you need to be back to work. We've got a lot of young people, as you know, graduates, and training is a key part of their growth. And also trading, you need to be talking to someone on the opposite side of a desk or going up to someone and making it happen. It's surprising to me the amount of businesses that aren't back to work. I don't really know how you can trade or move on without your teams, because our people are our success. 100%. And there's a relentless focus in this business to improve all the time, and we need to be together. And I think that's it's a huge accolade to the HR and the committees that got this got us all back to work. I will say there's a few things I'm excited about, but I'll just go back to the beginning. It is tough. It's really tough out there. But we are very, very small in what we do. You know, even though, you know, we're strong and the figures are strong, in what we do in the market that we're in, it's billions in the UK and trillions in Europe. So I think, you know, we're a 0.0 in the industry. So even though it's tough, we have a lot of opportunity, and our focus is to gain market share with these opportunities. So one of the big areas that I'm most excited about, again, our systems. We've been working, and we put it in the announcements, we've been working very heavily the last few months on robotics and AI, automatic intelligence. And these aren't the robotics that, you know, robots going around the warehouse picking. These are robotics in our servers and in our systems that we believe we've notified 1,000 tasks already that we can automate. And these tasks haven't come from the IT guys looking down. These tasks have come from our graduates and our people looking where we can automate things and change things. And we've done quite a few already. We can average about 30, 40 a week, but there's 1,000 to go at. This is going to save thousands and thousands and thousands of man hours, which will enable our teams to be able to think, to be able to do more innovation, to be able to take more money, because we'll be able to focus in more sales. So it's a sales, it's going to help us on sales, but just as important, we believe there's a big margin play in this, because we will be able to grow, first of all, stay on this floor, grow, and not take so many more people on. What we're going to do, what do we do with this margin? That's a bit of a question that we're thinking about now. Do we spend the money on marketing? Do we spend it on price? You know, we are a brand just above own label. Do we take the price down to own label? We're a brand at own label prices. I mean, no one will be able to compete with us. Or do we put it back into the profitability and the EBITDA of the business and give it to the shareholders? We've come to the conclusion that it's a bit of all three, and this is what we're going to focus on over the next 2 to 3 years. But it's to me, this is a game changer, and I will report more on it in November. Supermarkets. Supermarkets is now our biggest section of the business, and when we first did Float 5 years ago, I remember our chairman saying to me and Andy, Simon, Andy, you're only doing £1 million with Tesco's. They're the #1 supermarket and they're the winner. And I'm proud to say this. I'm really proud to say this. 2 weeks ago, we won General Merchandise Supplier of the Year at Tesco, which to me, to us and the team, is a massive, massive accolade. The reason we won it, we were told by the senior directors, was because #1, information, #2, on-time delivery, innovation, packaging. And what they meant by information was, it's been a real tough time for supply chain over the last 2 years. And they said to me, we know when you made a mistake, Simon, and it was once, and you rang up 10 weeks before the delivery. You told us there was an issue. You had a solution and it was dealt with. The A brands are not telling them that there's issues till the day before it's supposed to be going on promotion. And they're not even ringing, they're emailing, because a lot of them are still working from home. And they said, Simon, the differentiation between you or Ultimate Products and what's going out in the market is night and day. And this is your success. And all supermarkets have given us loads more business, and there's a lot more to come. Again, being straightforward, the volumes going forward have reduced. So where they were ordering 15,000 per line, it's now 10,000 per line. Well, that's okay, because we don't want them to be overstocked. We want our products to sell off the shelf, but they give us more capacity and more promotions to do. Internationally wise, again, I said to you, we're very small, but Kaufland is a great account, and they're giving us massive repeats and massive opportunities for more space. Lidl, Pennymark, Aldi, Bodronka, Netto, Pep. I mean, I can go on and go on, but the two big exhibitions we're doing in IFA, and the second one in Ambiente in February, where again we've been fortunate, we've got a much bigger stand. I think they're also going to be big players in our turnover and finding new accounts. So to go on to online, as you can see, we did have a tough year. We did a tough half year. We did explain that because the stock was short. We decided the stock we had, we were going to give it to the customer. We were going to give it to the retailers. Because there was a lack of space on the ships, it was, do we ship for the retailer or do we ship for ourselves? And at the end of the day, we are a wholesaler, we are a brand, we have to look after our retailers, and that's what we did. But now we are fully back in stock, and the figures are going the right way, 100% the right way. They're really doing well. And also, the new innovative products that we brought to market, we brought to market over the last 24 months, 2,000 new products. There is not a lot of, I'd like to shake hands with another company that has done that. 2,000 new products to market in the last 2 years when China's been closed. And our new product development, which is now going online and to our retailers, is going very, very well. Europe, as I said to you just at the beginning, we are now fully operational in our European warehouse. We are fully operational online, and figures are going up weekly. We only have 100 products there at the moment. Our product in the UK, our product SKU number is over 1,000 for online. So over the next 24 months, 18 to 24 months, we hope to get up to 800, 1,000 SKUs online. Key is, again, we're not supplying 70 million people anymore. We're going to supply 420 million people extra. So that's where the robotics, the online, supermarkets, this is why we feel confident. Still a bit scared, not going to make out I'm not, still a bit scared because it is tough, but there's so much for us to go at as a company. And I do feel with the people, the teams, I think we've got a fantastic opportunity over the next 24 months to come out of it again, a completely different, upgraded business, and that's what I'm excited for. So I think, Graham, I think I'll hand over to you to carry on with the figures.
Okay, thank you, Simon. Afternoon, everybody. So results then. So income statement, first of all, I can see there, there we go. Overall revenue growth was up 13.7% for H122. But I think it's important to look beneath that and see that the pre-acquisition business before the Salter edition was up 2.6% compared to the prior year, and that was in what I believe was an incredibly challenging environment with the backdrop of shipping, COVID, Omicron. There's so many hurdles thrown at us to then still deliver 2.6 on the underlying business was a very pleasing result. But I think even greater than that really is our gross margin result. You can see there we increased 160 basis points to 24.4, and the reason for the increase is not the real plus point that I see, but it was down to the Salter acquisition, the not having to pay the royalty on our existing Salter business, and also the higher margin that we get on the new acquired Scales business. The real amazing point to me, and it was a fantastic job by the commercial team, is that the underlying or the pre-acquisition business maintained the same gross margin as it achieved in H1 21. And this was against a challenge of increasing shipping costs, and that was equivalent of 4% adverse impact in gross margin. Because prior year shipping costs were sort of around about $1,500 for a 40-foot container, whereas this time round we've been paying around about sort of $8,000. And so, in spite of that 4% adverse headwind, the commercial team have managed very careful and very considered price increases, the innovation allowing them to bring new products and resetting the price, and then managing the stock that we did have to obtain the best result for that, and help us deliver the same margin that we've achieved over as the prior year. And that there's so many elements to our margin. It feels that there's always one headwind at least that we're being challenged with. And if you look back over recent years' margin, in spite of the various headwinds that we've had, we've always managed to deliver a fairly stable margin. And I think that is our the commercial team's ability to trade and manage that exposure and get the best result that we can for the business. So I really feel that is a fantastic result that the guys have achieved there. Going down to EBITDA, you can see it's sort of just under 29% growth, up to 11.3 million, with the underlying EBITDA margin at 13.1%, with extra developments forecast for FY22 full year being 11.8%. So a good improvement over the previous year. Clearly we've got the addition of Salter into the business, but very pleasing results all the same. Just to point out, the adjusting items, we're referring there to underlying EBITDA. The adjusting items just reverting back to what we call the normal levels, just the share-based payments, so no furlough repayments, no further acquisition costs, and just a fairly clean reporting position. Over on the next page, Hannah, you can see here this is a chart we maintain each year, so the profit after tax bridge. I really just want to focus on the first three green blocks there, showing the increase in gross profit. The first being the addition of the volume, the second being the saving from not having the royalty fee on the existing Salter business, and then finally the increase in margin from the higher value of higher gross profit achieved on the scales business. So that's those three components building together. But that most outstanding piece for me is maintaining the same margin on the existing business. Okay, if we then move across into the segmental analyses, the first slide is the geographical split, and once again, Germany is the key highlight here. Again, sort of very strong growth, unbelievable 59% growth over the prior year. I think that's a fantastic result. I think the products are going, selling very well in the supermarkets, and we're getting repeat orders. So I think Germany is our key focus in terms of the international areas where we have our showroom and where our majority of our sales team are based. And that German position has increased our international sales share up to just under 34%. And our medium-term target for that is to increase it up to 50% over the medium term. We then move on to the strategic pillars. I think another standout here is supermarkets. A great result. And a very pleasing reward from that service levels that Simon referred to in terms of the Tesco award. But 48% growth on the supermarkets, and that's now our largest pillar, up to 37% share of sales. So and very pleased with that development. Sam already explained on the online channels, the decline by making that specific decision to prioritize stock for retail, which is as we'd flagged up, I think the last time we presented. And then discount, a fallback there. It was a very strong sector over from COVID, from being, their store, many of the discount stores remained open. So we think that's reflecting a normalisation of the discount sector. On the brands, over on the next page, our key brands, our premier brands were up 28.5%. Very strong result, largely owned now, and as Russell Beldrain Salter showing strong growth above the average, and Russell Hobbs a very strong performance as a result of the growth in the international supermarkets in particular. But Simon mentioned earlier that so now that we own Salter, that is a real focus area for growth into Europe, and we see that as a great opportunity for us. And then finally, onto the product groups. Just really reiterating that we see that our key areas for growth in terms of products, it's the SDAs, the housewares, and laundry. Laundry was the one exception in this first half that didn't achieve growth, was down 9.5%. And that's reflecting its high concentration in the discount sector. As I mentioned earlier, discount has normalised this half, but going forward, we see laundry, housewares, and small domestic appliances as our key contributors to growth. Moving on to the balance sheet now, and I think the real point to discuss here and to explain is the working capital position. We highlighted before, or previously in recent, more than the last presentation, that stock has been depressed over the recent periods because of COVID, because of shipping and availability issues. So in explaining the increase in stock, I think it's probably clearer to go back to pre-COVID and look at the increase since January 20. And that increase has gone from 18 to 27 million. There are three real components of that. 5 million is due to the increase in volume, so purely trading driven. And having acquired the Salter business at the end of last year, we've now, as we've worked with it for over 6 months now, our merchandising team and the stock forecasting systems that we have, much better stock planning tools, we very strongly believe that we can run going forward with a stock level which is £2 million lower than the previous owners ran with. And so we see that over time we can see that element of high level of stock at the end of January reducing down, and then a further 2 million in the stock level was really to manage that shipping risk, to ensure to create a buffer stock. If we had the opportunity to bring stock in earlier, we'd take it and manage and ensure that we would still be able to deliver the customer service levels that they expect, maintain our high on-time delivery stats, and ensure that the retailers get their stock on time. So really the acquisition, the increase in working capital, that's what's increased the bank debt from being debt-free just prior to the acquisition, with net bank debt at the end of January of 30.3 million and EBITDA leverage of 1.9 times. Our headroom is still at the same level as July 21, so 17 million of headroom in spite of that increase in working capital. And that's really reflecting what we said before, in that our trade facilities are there to support flex increases in working capital, and that's exactly what they've done. So our headroom in terms of liquidity and on covenants still remains very high and very comfortable. And then finally, the cash flow, it reflects that snapshot view of the last 6 months of really the working capital increase. But if you look back over time, generally our working capital moves with increases in revenue. So that's what we'd see and expect to see over a longer period of time. As you know, this is a snapshot view of stock normalizing. Oh, actually, sorry, I didn't refer to trade debtors, so I'll just jump back on that one. So a significant increase in trade debtors compared to the last half year. 2 reasons for it. One was much higher levels of volume sales in December compared to the prior year, and also that movement in our customer mix, increasing share to supermarkets and the reducing share to discount. That generally the supermarkets have a higher trade payment terms compared to discount. So we've seen an increase in volume and an increase in debtor days because of the change in mix. It still remains within our normal debtor days expectations. So it's a change in mix that's driving the increase there. So just finally, then on the cash flow, I said it is a snapshot view, and that over time we would expect to see the debt return or reduce back down again, as we've proven over the years prior to the acquisition.
Hi everyone. So moving on to strategy and outlook. Those of you who are familiar with the business, if we go back to page 15, will be very familiar with this schedule. This is the same 4 pillars of our strategy that we've had really since we IPO'd, and it's as relevant now as it ever was. This is where we really focus our efforts and where we expect growth to come from. International, the large part of our cost base is committed to new product development. Well, historically, we've only deployed those products into the UK. So it's really going international is both a revenue play, but also an operating margin play, because we're flexing that new product development over multiple territories, and with only an incremental increase in our overhead. So international really big opportunity, and we're about 1/3 international at the moment, so we do see that going above 50% in the medium term. Number 2, supermarkets. When we IPO'd, we were underlight on supermarket. We were light on supermarkets, underweight. Simon illustrated that before with that anecdote about our chairman and Tesco. We've seen kind of 30% per annum growth in our supermarket business for a few years now, and it's now our biggest segment. Whereas back in 2017, discount was our biggest segment and had with 60% of overall revenue. Now supermarkets is north of 30%, and discount is about 30%. So we've really that's really made a huge difference to the quality and profile of the business. As we move internationally, we do see ourselves moving attacking on 2 fronts. First of all, down the supermarket channel into Europe, and secondly via the online channel. So I think as we do more international, we will do more supermarket business, because we do find that our brand and product offer in Europe does resonate more with the supermarket consumer than the discount consumer. Number 3, online. When we IPO'd, we were less than 3% of revenues from online channels. When we talk about online channels, we sell via platforms, so platforms like Amazon, eBay, and retailer drop ship platforms. Less than 3% on IPO, 15% now, and we have a medium-term target of 30%. And we think this is eminently achievable because when it comes to non-food, more than 30% of purchases are made online. So we do think this is a very achievable target in the medium term. And I think then what we would have is a nice balance and diversity between our key channels, between supermarkets, online, and indeed discounts, which would give us more growth opportunities, but also more resilience. And finally, discounts is really where we're from. As I mentioned before, when we IPO'd, we were 60% discounts. That's now moderated to about 30%. And discounts is still a growth area of retail. It's still very important, but it's also a more mature part of what we do. So we do expect growth to be going forward to be lower in the discount channel than it is, say, through supermarkets and online. So we go on to page 16. Thanks, Anna. So this, just by the way, on strategy, I would just say that we did a Capital Markets Day last year, and there is a video of that in the investor relations section of our website, which is a more detailed summary on the background of the business and a real deep dive on our strategic approach. So if you do want to know more about the company, I would encourage you to watch that video. It is, as I say, it goes into things in more depth than we have the opportunity to do so here. But this is a slide which I did table back then, and it was a bit of a crystal ball slide, I suppose. We were, what might the world look like post-pandemic? And back in February 21, I think we were still in lockdown, so it really was a look to the horizon. I'm really pleased to say it stood the test of time, because I do feel that what the points we made here back then are as relevant as ever, particularly with the cost of living crisis and the desire from consumers to save money, which we think will drive, continue to encourage, sort of home entertaining, time spent in the home, and expenditure being more considered. It feels like that statement from February 21 really does feel like an understatement now. It's clearly everyone is considering their expenditure very, very carefully. And then at the bottom line, retailers will favour reliable suppliers. Again, this was speculative, I suppose, but we are definitely seeing the evidence of that. The last 2 years have been a tremendous test of supply chains, and many have come up short. I think we have proven our expertise in this area and our capability, and that's been recognised by investors, but it's also been recognised very much by our retail customers, and they are seeing the value of that. And it's going forward. It will be, I think, a much more important factor in their considerations than perhaps was the case pre-COVID. If we go on to the next slide. So strategy and outlook, always the most interesting slide. We have guided and in line with expectations. You all have access to the equity development notes, which is on our website and also available on equity development's website as well. We're really pleased with this. We would have done better in perhaps a better environment, no doubt about that. But I think it does show our resilience in the face of external challenge. We are keeping a close eye on China. China is, we're still seeing lockdowns in China. In terms of the areas where we manufacture, they're quite localized, often at kind of local district level. If there's an outbreak, they close that area down. They do the testing, and then they isolate people who have tested positive. And we've been able to manage that very effectively. There was a Shenzhen lockdown, which was for a week. That's one of our main areas. Again, we were able to manage that effectively. We aren't particularly affected by the lockdown in Shanghai because we don't have much manufacturing in that region. So we're watching it very carefully, but I think so far so good at the moment. We are able to navigate our way through that. The cost of it's I said last time when we spoke to you in November that this has been the toughest operating environment that we've ever experienced the last couple of years for lots of fairly obvious reasons. We do feel that is easing, and we have communicated on that basis. We think, for example, shipping, while it's still costs are elevated and reliability is still poor, availability has improved significantly since the turn of the year. And while it continues to be a day-to-day challenge, we do think that we are past the worst. However, we are seeing, as Simon has highlighted, really some demand side challenges. There is a cost of living crisis. We before Ukraine, I think this was anticipated to be a spike. I think after Ukraine, I think I think everyone thinks that that this will last longer now, and this squeeze on the consumer pocket and this squeeze on consumer confidence is an ongoing issue that we're going to have to manage along with everyone else who works in consumer. We do have some mitigators here which are really helpful. We are at the value end of things, which is good. We aren't big ticket, which is really helpful as well. And the nature of our products are sort of semi-essential. So we do sell frying pans. We do sell mops and buckets, kettles and toasters, things which do need to be replaced from time to time. But the fact is the market for our products will be smaller over the next 12 months than they were over the last 12 months. And the way that we intend to address this, as Simon has highlighted, is through taking market share. Even if the market is down 5%, that's still 95% of a huge market. And we need to do what we've always done, which is take market share, particularly in Europe, where our market share probably rounds to zero at the moment. So why am I so confident of this? Well, we believe that we have come out of this pandemic stronger than we went in. We believe that our brand offer is much stronger, and the acquisition of Salter and, of course, the acquisition of Petra has really helped with this. We believe our product proposition is much stronger because we continue to develop products during lockdown. 2,000 products brought to market in the last 2 years, where our competitors didn't. And finally, we have found a post-pandemic way of working for us. For us, it does mean largely back in the office, but that can vary by company. But I think the point is we've figured that out. And we're on with it. And I think our observation is that many companies have yet to figure that out, and that is an advantage for us, I feel. The robotics side is the move on to that, and I think robotics will represent a meaningful competitive advantage, which will be both a revenue generator and will enhance operating margin. So overall, we've come out stronger, but what our observation is our competitors have been degraded during this period for the reasons which I've set out, and that's why I'm confident of taking further market share. If we go on to page 18, this is the investment proposition as we see it, and when I say we see it, we do have quite a lot of skin in the game ourselves. About half the equity is owned by management, because what we feel we offer as an investment proposition is an unusual blend of growth. We have a targeting a market of 500 million people across both the UK and Europe, with really headroom for growth for the foreseeable future. We are capital light, so that means we can pay a dividend as we go along. So we outsource our manufacturing, so we do have a 50% of profit after tax dividend policy, which has led to the 36% increase in the interim dividends off the back of the first half. Thirdly, I think we have demonstrated incredible resilience over the last couple of years. I mean, we went into this crisis with EBITDA of 10.5 million, and we're coming out of it with an EBITDA north of 18, despite all the challenges that have been thrown at us and indeed thrown at lots of companies during this very difficult time. So I think we've really demonstrated the sort of downside protection that investing ultimate products could represent. And then finally, because it is important to all of us and increasingly to the investor community, we do think for a small cap that we punch above our weight in terms of ESG. We do fully comply with the corporate governance code. We do a lot of community activity, and I would ask you to read our ESG report in the annual report, or indeed to follow us on LinkedIn. What we highlighted in the interim statements was in the annual report this year, we'll be talking much more about the E and setting sort of targets and pathways to net zero. So we do think our investment proposition is unusual and indeed compelling.
Given the pronounced further deterioration in the relationship with the West and indefinite maintenance of zero COVID policies in China, have you looked further into diversifying your sourcing?
Yes, we do source from 14 other countries at the moment, but there is a very big focus on more factories outside of China. But we'll never not source out of China. But if we target our buyers, which we are targeting our buyers, KPI'd and bonusing buyers to move as much, where they can move out for not even a cheaper price, but can find a similar product at the right price, and just diversifying a bit. It's a number one red on the buying team.
And just to go back to that point, I would just seek to sort of manage expectations in the sense that we buy all of our consumer goods from China. This isn't just the UP thing, and componentry too. So we are, as Sam said, we are very much, this is the number one red in the business. But the diversification away from China will have to be carefully managed and won't be an overnight process. So just to add to that.
Thank you. Does any one country in Europe represent the bulk of the 15 million of the first half other Europe sales?
Yeah, the major, probably the largest territory is Benelux, where we have a lot. One of our large European retailers is Action, which is based there.
Thank you. Sort of a longer, slightly more detailed consideration. I'm sure you, as you point out, 50% shareholders in the business are frustrated by this too. But when consumer issues, be it sourcing, be it shipping, be it cost of living, come to light, this investor feels that you guys, UPGS, get unreasonably hit harder, despite what you have done to prove to the market your expertise in managing these challenges. So the question hones in on what you can do to demonstrate to investors that you are able to manage these adverse factors proactively, and how you can turn them into positives for the company.
So I'll pick that up. I mean, I suspect the observation that bad news is punished disproportionately more than good news is rewarded is probably an observation that almost any sort of small cap sort of managing director would make. It is frustrating, and obviously as large shareholders ourselves, it can be it can be very difficult, to see that we don't get the recognition that perhaps we should get. But I think it is the nature of being a small cap. I suspect it's a complaint that many other managing directors would make. I think that what we've got to do is first of all, we've just got to prove ourselves by delivering. When in FY20 in 2020, when COVID first hit, our share price went down to 30 odd p. And sorry, my iPad's playing up. And we, excuse me, and what we did is we proved everyone wrong. I think we did confound people in the resilience we showed in dealing what was an immensely difficult operating environment. What we're seeing now is a demand side challenge, and I think we've got to prove to investors that we can deal with this demand side challenge, and I'm confident that we will do that. I do think, in terms of communication, I do feel that we make more efforts than most small cap businesses to engage with retail investors. I'm looking forward to doing more face-to-face, Hannah, when we can. But in the past, I've been to Mello a couple of times. I've been to your events. I've been to ShareSoc events. We always do these updates. So I think we do more than most to engage and hopefully to inform through that process. China is problematic in terms of a risk. I think we are overall a well-diversified business, diversified in terms of products, customers, channels, and even our factory base is well diversified. But we do have this concentration risk within China, and we are taking steps to diversify. But it is going to be not an overnight process. So we'll keep updating on that.
Okay, thanks. You mentioned in your results about additional process staff. Are these to help with automation? And if not, what is their role?
So it's all linked to the robotics initiative. So we just for those who don't know the business well, we as a supplier to retail, our business is complicated, and that's because retailers make things complicated for suppliers because it makes it simple for them. Exactly what I would do if I was in their boat. So we've always managed this complexity through use of automation and our systems and processes. Okay, the robotics is really the next step, but it's a huge step. It is going to be, to use the word Simon used before, it's going to be a game changer. And it's the process team that are going to do that work. So we've already identified 1,000 tasks that we believe can be automated using robotics, and we believe that's for starters. And from 1st of June, we'll be automating approximately 30 tasks a week, using the 8 members of our process team.
Thank you. Given the potential in Petra and Salter and the increase in working capital intensity of the business, what is the view on further acquisitions in the next 12 to 18 months?
We don't need to do any acquisitions. With what we've got in front of us, I'm not going to give a figure, but there's enough to do that will triple the business. So if we just do what we're supposed to do here, it's enough. I mean, if something comes up and it's the right price and it's a bargain and it fits in what we want to, we'll look at it. But we're not going out there to do more acquisitions. We've just got to deliver all of this, and it's Europe will be enough to make all shareholders happy.
Do you have an internal target date for European revenues to exceed UK revenues?
Not yet, but we have a main board strat day at the end of this month. But yeah, you know, we do expect, I suspect the conclusion we'll come to is in the next couple of years, we'll want international to be the majority of the business. I suspect that'll be where we get to.
As Andy has already kindly pointed out, we published on the back of results at the back end of last week. So if you do want to have a more detailed look at forecasts, you can find the research on our website or on UPGS's website. But we have no further questions, gentlemen, so we shall let you get off to your next meeting. Thank you all for your time and look forward to catching up in the next 6 months.